is from Mark Rendell of the Globe and Mail. Go ahead, please, Mark.
Thank you for taking the question, Governor. So the bank signaled that a pause is most likely, but you're still prepared to raise interest rates if needed. I'm wondering if you can expand on what "if needed" means. What would you need to see in order to hike rates again at this point in time?
Yes, as you said, Mark, we raised our policy rate today, and we've signaled that it's time to pause and provide some time to assess whether we've raised interest rates enough to bring inflation back to target. So, what does that mean? Well, what it means is that if economic developments, and in particular, if inflation comes down in line with our forecast, that'll confirm that we've likely done enough. If, on the other hand, we start to see an accumulation of evidence that inflation is not coming down in line with our forecast, we're prepared to raise interest rates further. I want to stress that this isn't going to key off one piece of data or one release. We're looking for an accumulation of evidence, and there, as you know, we follow a whole range of indicators. But clearly, some of the key things we're going to be looking for is, we're already seeing the effects of higher interest rates slowing demand in interest-sensitive sectors. We do expect that to gradually feed through more to services prices, which are going to take longer to come down. That's something we're going to be watching. We're going to be looking to see that inflation expectations come down with inflation. And importantly, we're going to be looking to see that inflation is indeed coming down in line with our forecast.
I just have Randy Thantong-Knight from Bloomberg.
Hi, Governor. Is there a risk that by explicitly signaling a pause that could reignite some inflationary pressure, and are you still more worried about the risk of under-tightening?
Well, I think we did a pretty thorough job of outlining the risks in the report. I think why are we signaling that we think it's time to pause? I think it's pretty straightforward in our own deliberations in the Governing Council. That was our assessment, and so we're communicating that clearly with Canadians. As I will underline once again, it's a conditional pause. It's conditional on economic developments coming in broadly in line with the forecast that we put out today. And look, if upside risk materialize, if we start to see an accumulation of evidence that inflation's not coming down in line with our forecast, we're prepared to raise interest rates further to bring inflation back to target.
Hi there, this is Kumada Ramanathan. Governor Macklem and Senior Deputy Governor Rogers, conversations on Bay Street have already started about interest rate cuts. What are the parameters for such a cut? And do you think these Bay Street observers are getting it wrong by discussing such a shift at this stage?
I think it's far too early to be talking about cuts. Look, inflation is still above 6%. Yes, recent developments have reinforced our confidence that inflation is coming down, but we have a long way to go to get back to our 2% target, and we are resolute in our commitment to get all the way back to 2%. As I've indicated, we're talking about a pause, and the pause is really a period to allow us to assess whether we've raised interest rates enough to get inflation back to target. We're trying to balance the risks of over and under tightening. We don't want to underdo it, and then inflation stalls on the way down. So, yeah, to end off where I started, it's way too early to be talking about cuts.